Hello everybody, welcome back to the channel. Thank you for checking out. In today's video, I wanted to go over what's going on in the market right now. I wanted to talk about the two big things that kind of led to today's results and give my thoughts on them as well. So if you like what you're hearing today, I would really appreciate it if you would like, comment, and subscribe. It really helps out the channel. All right, let's get into it. As you can see for the market, you can see that it was a very red day. We got the Dow down 1.55%. We got the S&P 500 down 2.5%. And then we also got the NASDAQ, the tech heavy NASDAQ down 3.68%. This week, we had a lot of companies report, and you're kind of getting two different sides of each company. You're getting the one company, or most companies are doing in this earnings season, where a lot of them are actually beating on the top and bottom line, but they're forecasting lower than what analysts were expecting. And that's the big trend that's going on. When you look at Airbnb, they did that trend. They beat on the top and bottom line, but they forecast lower than what analysts were expecting. And because of that, they were down as low as 13% today. You got Qualcomm, who did a very similar thing. They also announced that they beat revenue and earnings on the top and bottom line, but they're forecasting lower than what analysts were expecting. And this is what's going on this whole entire earnings season. A lot of these companies are forecasting lower than what analysts want to see, and they're showing that their business isn't growing. People want to see growth. Investors want to see growth. And you have a lot of these companies saying that, hey, we don't know how much we're going to grow in this next quarter. We don't know how much we're going to grow going into next year, and it kind of shows in the results. But then you have companies that are being rewarded for saying that, hey, we believe we're going to go even better. When you look at a company like Etsy that reported, they actually beat on the top and bottom line, very similar trend to a lot of companies, but also they are projecting that they're going to do better than what analysts expect. And that's something that you're not seeing a lot. You got companies that are mostly saying either A, we don't know how we're going to do, so we're not going to report our future guidance, or A, we're going to lower guidance. We're going to say that we're going to do less than what analysts are expecting. So now you got a company that actually saying like, hey, we think we are going to do better than what analysts are expecting, and they were rewarded because of that. As you can see, they were up to, I want to say up to 9% up for the day. So they're doing it extremely well right now because they're saying that, hey, we're going to do better than what analysts were expecting. Another reason why the market was down huge, and possibly the biggest reason, is we had another 75 basis point increase on interest rates. So this is the fourth time in a row they've done a 75 point basis increase in the rates. Now, people are saying that this is too aggressive because now we're hitting an all-time high. We're hitting the highest we've seen since 2008. And they have also said that they're going to continue doing this all the way into 2023. So they're being very aggressive with these interest rate hikes. The Treasury bonds has also increased because of this, right? And they're looking more attractive from an investor. You got some Treasury bonds hitting even 4 to 6%, 4 to 7%, right? Some of these Treasury bonds are hitting better than even you get from the market. Averagely, the S&P does about an 8% increase over time, but now you have Treasury bonds that are going to give you from 4 to 8, so a lot of people are thinking about a maybe a better option to do Treasury because of how high interest rates are. As like I said, this is the fourth 75% basis point they've done since 2008. So they're doing very aggressive with this Fed hike. You even got some people saying that they're being too aggressive and that this could lead to a global recession. They're being too aggressive. People are saying that they expect by March, if they continue on this way, by March next year, we're going to be at a 5% interest rate, which is very aggressive, right? The most aggressive that most people have seen in their lifetime. And obviously, like I said, the highest, we are at the highest that has been since 2008. So what are my thoughts on this? Now, when it comes down to interest rates, something to keep in mind is it does really two things, right? It increases the cost of borrowing. So I'm going to say that again for the people in the back. It increases the cost of borrowing. And because of this, people are less likely to borrow money and are less likely to spend money. because a lot of times people borrow money to buy a house, to buy a car. People even borrow money to go on vacation, go on trips, credit cards and things like that, right? So when interest rates are so high and people saying that it could go as high as 5% in March, people are way less likely to borrow money, meaning that they're way less likely to spend as much money as they normally would. I mean, just look at the example that we have on the screen right now. You can kind of see how much just a small increases in interest rates can really affect buying a house over time, right? How much extra money you're going to be spending over time, which can really make a difference on you wanting to buy the house, so you affording that monthly payment, all those stuff all together, right? So high interest rates are not a good way to stir the economy. They are a way to bring down the economy. They slow down growth, and that's something that you really don't want. One of the key things to always keep it in mind is we are number one GDP in the world. We have the largest economy in the world, and we want to continue having that by continue to grow our business, by continue to grow how much money that we make every single year. And with a high interest rate, you are preventing that, right? It costs too much money to borrow money, so people borrowing are less likely to do so, right? So something to keep in mind when it comes to that, it increases everything, right? It increases everything as far as the borrowing aspect, and it slows down the economy. So I'm not a big fan of high interest rates. We're getting to the ridiculous numbers right there, and this could trigger a recession. Yes, this really could trigger a recession because, once again, people aren't buying stuff like they normally would. People aren't going out there shopping. Now, I will say this, we did get our last GDP numbers a couple of days ago, about a week or two ago, and we did grow in GDP, so that's a good sign. So people still are buying stuff. They're not buying at the rate that they normally would, but people still are buying stuff. I get why the Fed is doing this, right? We talked about high inflation, and this is one of their key indicators to stopping inflation, right? This is one of their key things that they have at their disposal to help lower inflation. So I get it, but you just got to be careful. You got to be careful on how you use it. You got to be careful on how big you do it, right? How many basis point you increase interest rates, right? Because this is the fourth time they've done the 75% basis point increase. So we'll kind of see what they're going to do next. We'll kind of see how they're going to use it. High interest rates it's a good thing / bad thing, right? It helps slow down inflation. Those which we need, right? We need inflation to go lower, but it also slows down the economy as well. So it's something to keep in mind, guys. Thank you for watching the channel. I really do appreciate you guys being here. If you like what you heard, guys, if you can give a like, comment, and subscribe, it really helps out the channel, guys. I appreciate you guys being here. Thank you once again. You have a nice day, and bye-bye.